Hi everyone and welcome to Inderes TV. Today we're going to talk about Stockmann with Analyst Rauli Juva. Hi.
Hello.
Welcome. 45 pages of research, fresh from the press, written by you. And I can say there's no sugarcoating in this one. It's all facts and really interesting to read. We'll put the link down below. But Stockmann is on today's agenda. And if I start by saying Stockmann is what you buy, Lindex is what you get. What would you answer to that one?
Yeah. Pretty much so that all the value in the company nowadays is created by Lindex, and of course also the earnings and most of the sales. So in that sense, the Stockmann name is a heritage from the old days, and of course they are still running the Stockmann department stores, but Lindex is really the part that is the value and the more interesting side here in the case. Yeah.
So could you tell us a bit more about the business model? We have the department store side with Stockmann, and Lindex is a totally own brand of its own.
Yeah, indeed. So they are very different. Very different two divisions which they have. So Stockmann is the department store business, started in Finland 150 years ago, and they are running now 6 department stores in Finland and two in the Baltics, and that's mainly fashion. So fashion is clearly the biggest. So in that sense, that's the kind of similarity that they are both more or less fashion retailers, but a bit of a different kind. But in the department stores, in addition to fashion, there is cosmetics and beauty and some home products, and also in the Baltics they still have the food chains, which was sold from the Finnish department stores. So that's the department store side.
Yeah, and that's kind of high end brands, but no brand lines of their own, or some.
Yeah, they have own brands, like 10 to 20% of the sales are their own brands, and then the rest are third party brands, and they try to be, and that I think they have also the history and reputation of being a premium department store, but they are still quite big in Finland, and they are not like luxury. There wouldn't be enough demand to run that kind of network with a too narrow focus group. But yeah, that's what they are aiming. And then they have, of course, the web store as well there, but that's not so big part of the sales, at least.
How big percentage of the sale come from that?
I think it's around 10% now. It's of course peaked during the COVID times, and now it's going down. So it's a bit unclear where it will land when things settle down. But yeah, and then Lindex, they run practically fully their own brands. That's a clothing retailer, and the product split is good to understand, I think, because it 1/3 is lingerie, 1/3 is kids clothes, and those are both quite stable in nature, not that sensitive to like changes in fashion or even changes in the economy. So not really much cyclicality there in that sense. And then the final 1/3 is women's fashion, which is then more cyclical in both those terms, and more risky, and they actually did have issues with the collection and which kind of hit their earnings pretty bad five years ago. But like I said, they have their own brands, and they are selling them mostly in the Nordics, but also in Europe and a bit even outside Europe through franchising partners. And then they have in the recent years increasingly selling also through third-party web stores like ASOS or Zalando, so quite big e-commerce platforms. So that's of course the benefit, that when they have proprietary products and brand, of course, that they can also sell through other distributors, whereas the department stores are open to competition because their external brands are typically available, at least if you look in the internet, they are available in many other places as well.
Yeah, but this is kind of interesting because they have two totally different online shops. Stockmann has their own, and Lindex has its own, and then they have the third party collaborations. But what does Stockmann actually bring to the table in this combination if Lindex is the running the train kind of?
Yeah, who is running what? Of course, technically, Lindex is a part of the Stockmann group, and if you look at the organization, the group CEO is in theory at least leading Lindex. In practice, they are very independent. But if you think of the synergies, they were the original idea. It was 15 years ago when they bought it was that Stockmann was then going quite heavily into Russia and was in Baltics like they are now, and the initial idea was that they would help Lindex to expand to those markets, and they did actually, but then they pulled back from Russia, for instance. Both, well, good that they did a few years back already.
Yeah.
So that
was before the Ukraine.
Yeah, that was well before the current war, but I think actually pretty soon after the Crimea annexation, if I recall. But anyway, it was many years ago already. So that is kind of gone, and the only real synergy, at least to me, what is at the moment is that they are using the common sourcing offices that they are basically old Lindex sourcing offices that the Lindex sources their clothing through sourcing offices in Asia, mostly also in Turkey, I think, and Stockmann is using basically that sourcing platform for their own brands, so that is more of a benefiting Stockmann that kind of but that is the synergy anyway. What the small thing that it's kind of keeping them together. But other than that, like I said, their organizations are really separate. There is not much, if at all, like a group common functions or even leadership in that sense. So there is no reason why they couldn't be separate. And actually Stockmann was planning and trying to do that by selling Lindex, but then the COVID hit, and then they went into the corporate restructuring proceedings, and then the outcome from that was that they sold the real estate rather than Lindex.
Yeah, and I'm gonna continue on that sentence, because there was the original plan to sell Lindex, and now the world has changed and the plan has changed. And how do you see? I mean, Lindex has been doing quite good results in recent years, and Stockmann is still struggling. And as you mentioned, they're in this corporate restructuring program.
Yeah.
So could you bring us the details on how that affects the business and the investors and the history towards it? Okay, all warehouses are struggling, but the difference are so big here. Lindex is doing well, Stockmann is struggling.
Yeah, indeed. So, well, Stockmann department stores and whatever they have called it changed in the reporting a bit. But anyway, Stockmann department stores has been kind of doing losses basically 10 years or so. So that has been struggling for a long time, and they have been divesting the loss-making parts of that and also other loss-making parts of the whole group throughout the years. And Lindex has been doing better throughout the years, and then when COVID hit, they were unfortunately still not doing good enough, so that they still had quite a lot of debt in the balance sheet, and then when all the shops needed to close, or well, they didn't actually close, but all the customers left, so stayed home, so that then they kind of decided in the spring of 2020 that they need to apply into this restructuring to keep the company running, basically. In after math or hindsight, you could actually say that as the first wave of COVID wasn't really that bad in Finland, and when people came back to the stores in a few months, they probably would have actually survived that even without entering the proceedings, but they did, and then that led to the restructuring program, which was approved in February 21, 1.5 years ago, and in that it was decided that the real estate will be sold, and with those proceeds the debts will be paid back, and that's I think that was related to the fact that those were already, the real estate was already as a security in the debt, so it was kind of logical that now they will release that security and pay back the debt, and also in that kind of in the midst of the COVID pandemic, selling Lindex would have been probably difficult. Selling real estate wasn't probably easy either, but it was easier to get the money to the debt holders through that. So that's why they sold that, and also, actually now it shows that was in that sense good that they didn't sell Lindex, because it's performing now much better than it did before the pandemic. So the value is most likely higher than what they could have gotten there. But coming back to the restructuring, that's really a limiting factor for the company as long as it stands, because the strategy is pretty much kind of stated in the restructuring program what they are planning to do. They cannot do any big structural changes like spin-off Lindex or spin-off department stores either, I think, and they cannot pay any dividends, and they cannot do any substantial financial arrangements either. So
their hands are pretty tied up in this agreement.
Because the idea of the restructuring proceedings is to secure the kind of rights of the debt holders, and now even though they have actually paid out all the debts that has been agreed, there is still some disputed debts, and those have to be agreed, and all the court processes have to be cleared before they can exit the restructuring, and unfortunately that can take a couple of years if they are not kind of if they can't agree on those outside the courts.
Yeah, and that was my follow-up question, that it's a real kind of mess, that situation, and it can take several years before it's all wrapped up and done.
I think easily 2 years, even more if there is some complication. But it's also possible that they get some rulings on a few cases, and then they are able to settle the rest. So it's not impossible that will already resolve next year. But no one basically knows. So we'll see.
Yeah, that remains to be seen. But when you think about Lindex, they have a real strong market position, and they claim to have customers that are loyal and coming back. But with fashion, you don't really know, and you're also kind of critical to will they be able to show the margin levels they have done in the past, and boosted by the COVID, of course. So how do you really see it? And who are the field is really full of other competitors. Could you pinpoint out where Lindex is in that map?
Yeah. Retail competition is harsh, and I think clothing retail is definitely not one of the easier ones. So this kind of fast fashion thing, or affordable fashion, whatever you like to call it, it's the tough place to be, and obviously H&M is the big global name which we probably all know in the Nordics as well, and they are, I think, basically the market leader in most of the markets that Lindex is in, and then Lindex is in their strong markets. They are close behind that, so they are strong, of course, in the Nordics. They have in Sweden, I think we have estimated the market share is over 5%. Elsewhere, probably Nordics around that, and then below. In other places. So even if they are one of the largest, it's not that large, and that shows that the amount of competition is really huge.
Big. And we also have others like Inditex and Zara.
Zara chain from Inditex is one of the global ones. They are not so big in the Nordics, but if you look at European wide or globally wide, that's maybe this other global big. And then of course we do have Kappal, which was listed still a few years back. That's almost 1-to-1 peer to Lindex, so pretty similar size. So that is a good comparison as well. And we have seen also in the kind of listed sphere, MQ in Sweden went bankrupt when the corona started, and Stockmann owned Seppälä before, which went bankrupt some years ago. Both similar fashion chains to of course not exactly similar, but operating in the same market anyway than Lindex. So it is tough, and in that sense they have done extremely well if you compare to the historic earnings level, which for Lindex is quite decent to begin with, but they have done really strong now during the past 2 years, doing like 15% EBIT margin and around 100 million in absolute EBIT. So that's quite a lot, but that has been supported by some extraordinary factors in the currency changes and the savings they have achieved in the during the pandemic. At least that's what I think that is extraordinary high, and it will settle down to a quite good level still, but lower than the past few years.
Yeah. And they also have, I mean, the dollar is getting stronger by the minute, but and if I understood it correctly, Lindex is suffering from, because they're doing most of their purchases in dollars.
Yeah, exactly. They are doing that, and there was this. If I open up this exceptional situation that when Stockmann entered corporate restructuring, they couldn't do any FX hedging. So usually they hedge the purchases so that they have time to adjust the pricing. But when the corporate restructuring started, they couldn't do that for like 1.5 years from the spring of 2020 to towards the end of 21, and then lucky for them, then actually the dollar weakened a lot, without any hedges. They got it all directly through to their profits.
Okay.
And then now they are able to hedge again, but as the dollar have been strengthening, they are getting the effect with a delay. So now we saw that actually the first time in Q3 that the gross margin weakened quite a lot due to the stronger dollar, and of course it's a question of how competition behaves, and are you able to put that through pricing and all that. But like we talked about here, the competition is really fierce. Typically you don't or you can't or you don't want to increase prices that much, so you can be competitive in the market. So I think Lindex is most likely not able, and perhaps not even wanting to, trying to maintain those very high margins they got during the last years, but that they are probably happy with the bit lower margin as well, so they can remain competitive and still do quite a good profit. Yeah,
and keep the loyal customers.
Yeah, exactly.
Yeah, back in you talked here a lot about the real estate of Stockmann, and back in the day, Stockmann was really known for owning the best premises in town and owning their own space. And due to the restructuring deal, they sold everything.
Yes.
And this really affects the business in many ways. Not only due to the fact that they nowadays pay rent for the premises, and this is kind of linked to the sales, if I understood it correctly.
Yeah, at least partly.
But it also affects the way an investor should look at the balance sheet and the results, income sheet. Could you please elaborate that, because it's really important when you think about, when you put it in perspective of valuation as well. And there also this terminology I'm looking for, and it's IFRS 16.
Exactly.
That's the one.
Exactly.
Could you please elaborate what it's all about?
Yeah. So IFRS 16 is the accounting standard that was adopted back in 2019, which effectively meant that before that you had, if you were leasing a premises or whatever, it can be machinery as well, but in this case it's the buildings or the department store premises. The lease was booked as expense in your P&L, and that was it.
Yeah.
And now when it's IFRS 16, the leases are in the P&L statement. They are split to depreciation and financial cost. And then in the balance sheet, you have so-called right of use asset from the leases, kind of the right to use that. And then you have leasing debt, which kind of correlates with how long the leases are. And like Stockmann, with a similar case with some other retailers that especially with Stockmann, the leases are actually very long, especially in these new ones that they have just sold the properties and they have leased them back like for 20 years. And so that means that the leasing debt in the balance sheet is actually huge. And in at least our view, that is not a real debt. It's not something you need to refinance or pay back. It's just a technicality. So you shouldn't actually think of that when you think of the valuation. And another very important thing is that because part of the leases in the P&L are dropped down to the financials, then
you really have to go down.
when those leases are big, like for Stockmann, that really makes an impact. If they are small, it can be like just 1 million impact for a larger company. It doesn't make any difference. But in Stockmann, it's really important that if you look at the department stores division level earnings, which is reported on EBIT level, like they typically do, that's actually a bit misleading, I would even say, because then you have the part of the rents reported in financial cost and in this case the cost from the rents in financial is like 25 to 30 million for the group, and the vast majority of that is for the department stores, meaning the Stockmann division. So even if they are reporting, or they are now close to zero at EBIT for the Stockmann division, that actually means that the kind of cash flows and the underlying result, as I would say, it is like minus 25 million or something, and that of course makes enormous difference on the valuation and also on the considerations of can you maybe spin these off to a separate entities.
And to be really clear here, when you look at the books, EBIT is no longer a good standard measure for Stockmann. You have to go way down the lines in the sheet in order to get the rents in.
Exactly.
And this is the point, which could be really misleading if you don't know what.
Yeah, and that's very, very important for Stockmann in particular, and any company which has a big IFRS 16 liability, basically. But And then there's even one more kind of twist to it that if this is not enough, that actually then the IFRS 16, for some weird reason which I have not understood, treats the sale and leaseback arrangements differently than a normal lease.
Okay.
That if they would have a normal lease on the department stores, it would it's a similar technique. But if you do a sale and lease back like Stockmann has done, it actually
selling the property,
selling the properties and leasing them back to themselves. It's actually makes the depreciation component and the right of use component in the balance sheet much smaller than it would be in a normal lease. Like I said, I don't understand why, but this is
so where does the rest go?
Nowhere. So that's another problem with Stockmann, that very much of the rents are
my choice.
Very much of the costs or a big part of the costs are in the financials, but actually a part of them are nowhere in the P&L. So actually the cash flow impact from the rents in total, even if you take into account of ones in the financial items, the cash flow impact from the rents is bigger than what is shown in the P&L at the moment.
This is really interesting, but hard
and confusing.
Very confusing because it's still a cost. Where does it disappear?
Yeah.
Okay. And if you listeners and viewers, if your heads are spinning at the moment, it's not your fault. No, this is really.
No, I've spent quite a lot of time trying to understand this, and hopefully I got it right, at least as right as I can get them. Hopefully the company can at some point give some more color if needed.
Yeah, but how should you look at this as an investor? That's the most important thing here.
Yeah, good question. You mean the IFRS 16?
Yeah. These are stuff you have to take into account, but if nobody really gets the idea.
Yeah, this final twist with the sale and leaseback is really hard to grasp, because the company has not really given any numbers on it or commented on it, nor can you really actually kind of kind of work the numbers from their public figures in any way. So that's really tough. But if we don't go into that, it's then you, if just by looking the pre-tax profit level or the net income level and using valuation methods linked to those, then you should be quite okay. At least you are much more correct than using, for instance, EV/EBIT and trying from only that to adjust something. For instance, some people are doing that. They understand that they should deduct the lease debt from the EV because it's not real debt, but then they use the EBIT without the cost from the financial items, and then you get actually very low EV/EBIT figures, which can be kind of misleading,
totally misleading. Since the cost of the release is not there.
Yeah, exactly.
Yeah, and needs to be found down the line.
Yeah, and obviously we have tried to do all this in the report. So.
You should really read the report in order to get a grip of what we're talking about. But makes it hard to evaluate.
Yeah, it does because, like I said, all the headline numbers are not really what they seem to be.
Yeah. Interesting. But if you're talking, try to put all this into words. If we look at the business and the market, what do you really see? I mean, how would you look at the case? The return on capital is weak, and Lindex can generate value, but as you also wrote in the report, that it's kind of a lot of stuff depending on Lindex and the shoulders. Yeah. And still, as we told already, the fashion business is really hard. And since, if you do a bad collection, you can be out. And since Stockmann no longer owns any premises, the financial risk is also getting bigger, refinancing after bad years. How will you do that if you don't have anything to lay back on? Or am I too negative here?
Yeah, well, luckily now they are debt-free or net debt-free. They are on a net cash position, and at least with the earnings level we are forecasting for Lindex, they will remain cash flow positive after the big logistic investment they are doing. So that will consume part of their cash, but they will still be a bit net cash after that and cash flow positive. So I think a weak year on Lindex alone would not be a financial problem for Stockmann, but that of course then combined with also some more difficulties in the department stores could be an issue definitely, or if they for some reason would have to accumulate debt before that, then that could be a problem. But hopefully they would not run into those difficulties.
But do you see more possibilities or risks?
Well, it's a good question. I think we have, of course, tried to balance that in our estimates. So from this level, if we think at the earnings, definitely risk, of course, because they are very high, and we are forecasting lower earnings for Lindex as well. But from the level we are forecasting going forward, there is I think quite balanced situation in that sense that hopefully you would assume that no business is kind of allowed to run quite meaningful losses throughout the years, so they have to do something about it, and it's not easy to fix that, and I don't know how that actually is done. So that's why I'm not expecting that in the next few years, talking about the department stores, of course, now. So but in some horizon, you would expect that to be either closed down or turn around in some sense, and that would then give quite a lot of value for the whole group, and that's kind of also the key to actually unlock the value. So already now we argue that the value of Lindex alone is much more, actually almost double to what the group value is now. So if they are able to separate it or improve the performance of the department stores, there is really value from Lindex to be unlocked. But as we see it now, the department stores are running so deep in negative earnings and cash flows that it cannot survive as an independent company, and that's why you cannot separate them at the moment. But you rather need to improve the earnings and performance of the department stores, and actually then when you do that alone should already lift the value, and then separating them, it's not probably so value creative anymore, but could still be creating additional value to that. So these structural changes are really the kind of upside in this case, but that would just require that the department stores would perform better, that they could actually do that.
Last but not least, at the end of this 44 pages of written text and research, recommendation and a target price for this.
Yeah. So we started at reduce and €2, so around the level where the share is now, and that's really reflecting pretty much what I just said, that there is value, but we do not see that being unlocked in the next few years. Our target price is 12 months, so it's next 1-2 years we don't really see much happening, which is partly due to the restructuring process, partly due to the weak earnings and cash flow in the department stores, and then also on top of that, of course, when we are forecasting in this pretty weak consumer environment, we are forecasting the demand and earnings to come down, and if the earnings come down and nothing happens on the structural value creation side, you wouldn't really expect the share to perform much higher, at least. So with our estimates for the next basically 2 years, it's pretty similar valuation. It's PE 12 and EV/EBIT of 9. We think that's quite fair. That includes, like said, quite a big losses from the department store. So if one thinks, or we get some visibility that they could be actually turned around, I think that then that valuation would be even more the cheap side. But so far, at least I don't have any good ideas or have seen any ideas from the company either how they could do that, because they have been struggling with the same problem for 10 years already, basically. So let's see.
A lot of struggle and wait and see ahead.
Yeah, unfortunately, so I believe that you will have to wait for quite a few years in this case if you want to kind of see the unlocking of the value, which hopefully will happen someday, but at least we are not seeing it in the next few years.
Yeah. Thank you, Rauli Juva, for all these comments.
Thank you.
Thank you.